if you're looking to invest in stocks for your tax-free savings account, there are a couple things you need to consider. The first is, of course, the dividend yield, because the higher the dividend yield, the more income that means for your tax-free savings account. But in some cases, the dividend yield can be really high, and that can be a sign that it's a bit risky. Because generally, if it yields, let's say 10%, that means there's probably something wrong with that business. Because if you think about it, the dividend yield is a function of the price and the dividend that you get from that stock. So the higher the price goes, the smaller that yield gets. So if a stock was yielding 10% and it was a good buy and it was a safe buy, then people would buy up the stock, the price would go up, and the yield would shrink. If the yield isn't shrinking, that tells you that there's something wrong. There's some reason why people aren't buying up that stock. So it's important to understand the why yields are high, and whether there's too much risk. So once a stock's paying more than 5%, it's worth asking those questions to just make sure there aren't any surprises as to why the yield's so high, whether it's potentially unsustainable, is it due for a cut, is there serious risk involved. So it's important to ask the why. If a stock's yielding 1 or 2% or 3%, it may not necessarily be risky. It still can be, but it's particularly important once you start looking at high yielding stocks, because you're buying them probably primarily for that high yield. So it's important to know the risks involved. The second thing you need to consider for a TFSA is where these stocks are based at. Because if you invest in US-based dividend stocks, then you're going to be charged a withholding tax of 15%. There's no form you can fill out that's going to avoid that. You're going to be hit with 15% on your dividend income, unless it's in an RSP. But in a TFSA, you're going to be charged with 15% tax, and there's no way you can get around that. So if you're investing in stocks for a TFSA, I'd highly suggest focus on Canadian dividend stocks, just because you're not going to have that withholding tax. And odds are you can get a better yield with Canadian dividend stocks anyways. So that leads me to three Canadian stocks that pay fairly high dividend yields, more than 5%, that are near the 52-week lows, and I think are good buys for the long term. The first one is Toronto Dominion Bank. So right now, its yield is about 5.4%. The stock is near its 52-week low of just around $74, so it's about $1 higher than that. And if we look at historically where it's been, we can see that the stock normally doesn't yield more than 5%. So if you can get it at a 5% yield, you're getting a pretty good deal for TD. It rarely goes above 5%. Now it has in the past, in the 2020 crash, the thing spiked up to even more than 6% temporarily. But if you can get it at more than 5%, you're getting a pretty good deal for what's probably one of the safest bank stocks in North America. So a pretty high yield. It's never cut its dividend, and it's likely that the dividend is going to rise in the future. And for the long run, this is a good stock to hold on to. The only reason you may want to consider not buying TD is, if you just want to use that money for growth stocks or other investments. I mean, this is not going to be a stock that is likely to double or triple your money. I mean, maybe in the very long term, but if you're talking a few years, TD's probably gonna rise in value, just as economic conditions improve. The main reason its yield is as high as it is right now is because of inflation, because of rising interest rates, concerns about the economy and a possible recession. But in the long run, those issues will fix themselves out, and this is still a really good buy for the long term. So no real flags around TD's business. Is pretty solid when you're looking at the long term. In the short term, sure, there could be some volatility, but in the long run, it's likely to go up, and this yield is likely to come down back under 5%. So if you get it now, it's a really good deal. The next two stocks I'm going to group together. We've got BCE and we've got TELUS. They're both large telecom providers in Canada. So TELUS is paying 7%. BCE is at 8.6%. So really, really high dividend yields here. And this again goes back to the high interest rates. So the problem with these stocks is there's not really as much interest in them right now. Investors can get higher yields from bonds than they typically would, and so there's not as much interest in dividend stocks, and particularly in telecom, where debt levels are high, companies are involved in capital intensive businesses, whether it's building cell towers. Their assets are capital intensive. They need a lot of money to develop that and to build the infrastructure. So that costs money. They require debt, and debt's really expensive right now with interest rates being high. Even though Canada's recently cut interest rates, they're still fairly high. And if you look at the long-term trend, this is not a problem related to just BCE or TELUS. We can see even the U.S. carriers, Verizon, AT&T, haven't been doing well since 2022 when rates started to increase. Now, AT&T isn't doing as badly, but it's had a lot more of a decline over the past few years. We can see Verizon has also been tanking, down more than 20% since 2022. So these stocks have generally been following the same sort of path. So they haven't been good investments since rates have been starting to come up. And that tide's eventually going to turn once interest rates come down and bond yields come down, and then income investors start turning more to these dividend stocks. And that's when these prices are likely to improve, likely to increase, and these yields will come down. BCE tell us they're not going to be paying more than 7%, more than 8%. In the long run. Eventually, these yields will come down just like they will with TD. And that's why buying them now, while they're near their 52-week lows, while their yields are high, this can be an opportune time to buy them. So I think TD, BCE, TELUS, all really good dividend stocks to buy right now, buy and hold while they're near their 52-week lows and while their yields are really, really high.